Take a 66% profit on oil. We've had multiple profits on natural gas this year. We're going to rotate these profits into a new position, EUO, that's long dollar against the euro. ETHE, the Grayscale Trust for Ethereum. FNGU, the top 10 oil and gas companies leveraged times 3. US Treasuries, TMF, the long end of the bond market, leveraged up. And a VIX play with leverage, UVXY. Best way to do it is just log into your membership area, punch in your total capital, and then rebalance. It was pretty complex to explain exactly with the 6 boils how many you sold versus how many of each share you purchased. Our high risk portfolio is now up 48% year to date total return. For every unit of investment, we're coming in at a cost of $2,580. You should have 19 shares of UVXY, 36 shares of TMF, 14 shares of EUO, 57 shares of ETHE, 27 shares of FNGU, and 1 share of NRGU. Now, again, if you log into the membership area, up top where it says total to invest, calculate, punch in how much money you have to invest, and it'll automatically calculate the exact amount of shares to purchase. On the defensive side, we're along the VIX, bonds, and the dollar. And on the offensive side, we're along Ethereum, the big tech companies times 3 with FNGU. And then we're still hedging against inflation due to the war with NRGU. We got to remember, oil is still at a very high level with the US dumping its SPR, strategic reserve, at record pace, and that's going to stop in 90 days. So until the war ends, we do want to be long NRGU. Also, one of the big positions in that Occidental, Warren Buffett has been buying massive amounts of shares in to hedge his biggest play in tech, which is Apple. Now, there's only 3 spots available per day at special pricing, so don't miss out. Call Dean now to upgrade at 505-322-7515. If you're a paid member and you want a better position than ETHE, call Dean and ask about Rebel Dividends. That's our private equity where I manage your Ethereum position with leverage and diversify it into the top software applications being designed on Ethereum. Here's some slides that came out today that I found useful. So we're still bullish on the markets, clearly, but we've taken a massive profit on our natural gas hedge. First of all, there's massive amount of cash on the sidelines. If this were to enter the market, we could get an extreme melt-up. US rate futures are pricing in a higher probability of a 50 basis point rate hike in September after the latest minutes, which said the Fed was worried they might over-tighten, cause a deep recession. Zero Hedge comments, minutes, TLDR, Fed only cares about gasoline prices, and as long as these are flat or dropping, the S&P 500 can go to 5,000. New headline, Biden pauses the gas oil leases again. Chai Girl says US seems hell-bent on following Europe down the energy crisis abyss. Small businesses all across Europe are shutting down because energy costs are up 500% year over year. JP Morgan's Marko Kolanovic says he sees 4.7% global CPI by year end. Risk appetite is justified, increasing the likelihood of a soft landing. All right, let's go through the trade alert step by step. And sorry about my funny voice today, guys. I got kicked in the throat playing volleyball of all things, but it's healing up. Step 1, buy 19 shares of UVXY. That's our crash insurance hedge. Back in March of 2020, when the S&P 500 declined 25% in a single month, UVXY went up over 1,000%, more than protecting your portfolio if you had a 10% position. We're slightly under that right now, but we're getting ready to add to it soon. Whenever the dollar goes to this extreme, we need to be prepared for potential crises that will likely feed out of emerging markets or Europe. And so we're keeping a close eye on Asian and European stock markets for contagion, but a strong dollar is really the kryptonite for stock markets abroad. And we're now long the dollar in case this overshoots to a higher level. What would cause this is China and Europe being forced to be dovish while the Fed continues to over-tighten. Now, I do think they won't make that mistake, but in case they do, EUO is there to protect us. Fed rate hiking cycles have often led to stock market crashes. Now, this chart doesn't show you all the times they've pivoted and saved the market, but we do need to realize if they overdo it, we're going to get a VIX and a dollar spike. Not predicting that right now, but we're hedged in case. This chart shows us some of the bad periods of stocks. Some of them have been inflationary issues. Some of them have been deflationary issues. In general, I think we're more in a deflationary environment. We'll look at more data to explain that, but we're not expecting a decade of inflation. And with inflation peaking out and falling, we want to be long growth. Step 2, buy 36 shares of TMF, the deflation hedge. Here's a look at TMF over the last 3 months, trading essentially flat. Here's a look at what TMF invests you into, which is the TLT with leverage. We can see it's on a clear uptrend over the past several decades, and it's had a massive 2-year sell-off. We're expecting this to go back towards those recent highs over the next 4 years. Here's a 1-month view, or excuse me, year-to-date view of the TLT. You can see it bottomed out at 108, rallied up to 119, and is currently at 114. Great day to buy TMF. Other bond markets, which we're not invested in, but following, include LQD, which bottomed out at the same time and has been recovering. This is the investment grade corporate bond market. The junk bond market has the same pattern, also recovering. If we look at other durations of the US bond market, we'll start off with the 3-month. This is alongside the 2-year, what will likely dictate what the Federal Reserve does. And so what we're seeing is an inverted yield curve that the markets are predicting the Fed must ease, otherwise create a crash. We'll show you that data. But you can see the 3-month has had the sharpest rise in its history. It's likely topping out, getting ready to fall. And this will coincide with the Federal Reserve slowing down its rate hikes as inflation starts to slow down on its own. Here's the 3-month view of the 3-month bond. And you can see it's been going parabolically straight up, 150% return over the last 3 months. We want to see this flatten out and start to fall. 2-year has the same pattern. And while it did flatten out and start to fall over the last several weeks, it's rocketing back up. So the bond market's starting to become less convinced that the Fed will be able to slow down rate hikes in the short term. Now, the longer end of the bond market is correcting. So we can see the 10-year has fallen 3% over the last 3 months, meaning rates are falling and the value of the 10-year is going up. So the short end is rising while the long end is falling, making an inverted yield curve. Same pattern with the 30-year, but more aggressive. We can see it's also falling. Now, the inputs for inflation are all down. There's really only a few sticky prints that we have to worry about. Lumber futures, while up 60% over the last 5 years, are down 51% year to date. Copper futures, while up 300% with historical values, are down 18% year to date. The Baltic Dry Index up 17% long term. However, it's down 80% year to date. Wheat futures, which are up 55% based on historical data, are down 40% over the last 3 months. The CPI, which is approaching levels last seen in the 70s, potentially has topped out. And now we're starting to see it fall. PMI data is heading to negative territory, warning of a decline in the US economy. Consumer sentiment is at 2008, 1990, and 1975 levels. This is typically a great signal to buy the dip. The consumer is usually the last one to figure out what's going to happen next. Initial claims are starting to rise. And as you can see, the 10 over 2-year is inverted. As far as getting worried about a stock crash, we want to watch this steepen. In the short term, this is very bullish for growth assets. Here's that core inflation rate, which we'd like to see fall over the next several months to reinforce our view that the Fed can slow down the hawkish talk and become more accommodative to markets. If the core inflation jumps to new highs, the Fed will be forced to tighten aggressively. Here's a look at the breakdown of the most recent core CPI. And the one that had been driving it sky high was the pink section in energy. Currently, the services and food are only driving the CPI higher at this point. Now, other inputs that are driving it higher are rent. This is going sky high. People are jacking up rent as much as 40% across the nation right now. But it's a lagging indicator. If we look at housing prices, those have fallen 15% from recent highs. This will most likely drag that rent pricing down over time. Hourly earnings are also driving the CPI higher. So we have a labor force that's shrinking and wages rising. That's not good for the wage input. We can see this is rising at 5%. Now, with companies announcing layoffs, big corporations having too much inventory, I do think that will cool off on its own. On a quarterly basis, the unit cost is up 9%. Again, we haven't seen this type of wage pressure since the late 70s. Now, here's a look at gasoline. This is falling, perhaps the most important data for the consumer that they see every single week when they fill up the tank. That's going in the correct direction. Used car prices have finally stopped driving the CPI higher after falling. Container ship rates are falling rapidly, and PMIs across Europe are in negative territory. Every bond market is improving in terms of lower interest rates. So this is going the right direction for the Fed. Meanwhile, initial jobless claims and continued jobless claims continue to grow, showing the weakness in the labor market starting to crack. New home sales topped off at a median price of $450,000, down to $400,000 in just a month. And again, the retailers thought there's going to be a never-ending demand for goods and overstock. Now we're getting the bullwhip effect. They're going to be discounting all these products into the hot season. Step 3, buy 14 shares of EUO, the quantitative hedge. So the Fed's about to start dumping bonds and potentially raising interest rates aggressively. This can make the dollar go up, especially if China and Europe are going to have to ease because their economies are faltering. Not necessarily going to cause a US stock crash, but this could cause the dollar to go up against the euro quite aggressively. That's our new play. This year, DXY is up 11%, but EUO, with the leverage it provides, is up 25%. Here's the dollar versus the euro. If this is going up, you can see the dollar is strengthening against the euro. Here's the dollar against the yen, same pattern. The dollar's been strengthening against the yen. And the same thing with China, with the dollar versus the yuan. Now, here is the Fed's balance sheet, and they're just getting started with quantitative tightening. If you believe what they say, they're going to dump $3 trillion of bonds into the market over the next several years. We'll see if they really do that or if they pivot and slow that down. Same thing's starting to happen in Europe, but again, they have quite a crisis in their economy. So we'll see what they can actually accomplish with that. Step 4, buy 57 shares of ETHE, the ultimate growth asset. We're entering a new bull market for cryptocurrencies. This chart is predicting a 200,000 Bitcoin in 2 years. I think this cycle will last a bit longer than that, but we'll be watching the bond market to predict that. Now, why do we like crypto in general? It's because we believe governments will spend more money than they make, devaluing their own currency. And here you go. This is the US Federal's budget deficit projections, going from $1 trillion a year to 2.3 trillion by 2032. It's the only way they keep this Ponzi scheme of the government running. They have to continue to grow the debt to make good on all their liabilities and inflate away the debt. Here's a look at Ethereum over the last month, up 35%. ETHE up 24%. And again, if you're in if you're in Portfolio Builder and you like a more aggressive Ethereum play, managed by myself, call Dean and ask about Rebel dividends. It's only available to paid members. You're going to get a leveraged play in Ethereum that's diversified into the top software applications that are being designed on the Ethereum operating system. So call Dean at 505-322-7515 to take advantage of this. Some headlines. BlackRock says Bitcoin's index of money laundering. BlackRock is bullish on blockchain, but not Bitcoin. That's 2017, 2021. 2022, BlackRock picks Coinbase to provide clients with direct Bitcoin exposure. It's the biggest money manager in the world, managing $10 trillion. Now, if you thought you're too late on Bitcoin because it's outperformed every asset class ever in terms of return, look at the adoption of the technology in the US. It is tiny. It's barely at several percent. Other technologies have been completely adopted. So we can see we're very early in this adoption. Now, we like Ethereum over Bitcoin. Bitcoin may be sound money, but Ethereum is creating technology to replace just about everything that you can imagine. And it's having very successful applications already in use. And we can see now there's more open interest on options for Ethereum than Bitcoin for the first time ever. Also, we've had a rare reading where the 200-week moving average was gone under in Bitcoin. This has led to massive melt-ups in the months ahead. And so we are aggressively getting more and more aggressive into Ethereum. Same reading with the RSI. So I do believe the low is in. We just had the worst month ever for Bitcoin and the worst quarter in its entire history. This has often led to exceptional returns shortly after. And just to get a feel again for why we like Bitcoin, the US is addicted to an exponential growth of debt. 7 trillion added since March 2020, when it took 215 years to do that at the start of the US. Step 5, buy 27 shares of FNGU. We're going to diversify our growth position with some of the monopolies in the market. This is a 3-time leveraged tech play with 12 giant tech companies that all have monopolies in their respective markets. FNGU is up 26% in the last month. And with the Fed potentially pivoting, we can see several instances where the Fed began to tighten and then pivoted, and you got a very beautiful stock market return. Now, the key is that inflation really does start to fall as we're predicting. In this chart, we can see what caused the most recent melt up, and it was short covering. There's still a lot of short positioning getting ready to be eaten alive if this market continues going higher. And if you're not sure if the tech companies are still doing okay, Amazon just had a record-breaking Prime Day, $13 billion. Walter Bloomberg says from June 16th to August 12th, short interest in the US stock market increased $125.7 billion. So this is all getting ready to short squeeze. The market doesn't pull back here. Here's a look at some of the indexes we're playing in the Safe Growth program. With UPRO, we have exposure to SPY with leverage, only down 8% year to date. The NASDAQ now only down 13% year to date. Emerging markets still underperforming, down 16.5% year to date. Ray Dalio just sold his Alibaba position, new headline that just hit. And then we're watching Europe. If this is going to have a complete meltdown, we may want to get out of the way of stocks. So far, it's still hanging in there, down 17% year to date. Other plays we have in our portfolio, we're long uranium for nuclear power, down 15% year to date, but starting to recover. Rare earth metals, this is what is used to mine lithium, which is critical in electric everything, cars, phones, you name it. Down 9% year to date, but starting a nice recovery. Some specific stocks we're tracking, Amazon now only down 13% year to date. Apple is now up on the year. Alibaba, again, down 30%. So China continues to struggle with a weak domestic economy. Now they're starting to pivot. Now that they can see the US is going to slow down its hawkish talk, it's going to allow China to get away with stimulus without their currency imploding and bond market imploding. So that's what they've been waiting for, is for the US to slow down so that they can start to ease. Tech stocks are not nearly as irrationally priced as they have been in other bubbles, as they print massive profits. Now, if we are in a recession, which technically we are, we had 2 negative GDP prints, you don't want to buy the dip at the end of the recession. This is showing you somewhere around the middle is the best time to buy. And the 12-month return after that averages 43%. This is looking at the PE multiple that we fell to, which was 14. We've now jumped up to 18. So these companies need some good profits to maintain these levels. We'll see how this plays out in the next 2 quarters. Corporate insiders are massively buying the NASDAQ, as indicated in this. The job market continues to come in strong. Now, this print, while looking a little hot, was mostly part-time jobs. So a lot of people are having to work 2 jobs to get by. Full-time jobs actually decreased by 70,000. So not as hot of a job report. And we don't really want a super hot job report for the way we're positioning, being aggressively long growth and expecting the Fed to pivot. Credit continues to expand on both the consumer and bank level, and retail sales just jumped 1%. So we're still printing record levels of consumer spending, which is what drives the US economy. Balance of trade, while shrinking, is still highly negative, showing the US has still got a big demand to import goods and export dollars. While the US house sales have fallen rapidly, they're still cranking out very high levels of housing sales. We're not seeing a complete collapse, we're just seeing a slowdown. China, after shutting down its economy with its zero COVID policy, is trying to reopen and hit a 5.5% GDP target. They're going to have to stimulate a lot to pull that off by year's end. We're coming into some critical election processes for the leader of China, President Xi. If they have a very weak domestic economy, he might be in trouble of maintaining power. Chinese exports remain extremely strong, almost at record levels, while imports are relatively weak compared to recent highs. Not terrible, but not showing near the strength of the exports. So we can see China has a very weak domestic economy, and it's primarily due to basically building things that nobody uses. But they're going to have to continue that, otherwise face severe economic problems internally. Step 6, buy 1 share of NRGU. That's our inflation war hedge. This is Peter Zahan basically making a whole pitch that economies are going to be reliant on energy and that war is inflationary. To sum it up, really, as long as the war is marching along, we want to be long either oil or natural gas. Natural gas just broke to a new high, so we took a massive profit. Could it go much higher? It sure could, but I don't like the risk-reward ratio on that. So we're still long oil. If oil gets a big pullback and the war is going to go on for months, we could re-enter that position. At this point, I'm worried the war may end in September when Russia takes over Donbass. So far, all we've seen the Ukrainians do is blow up an airport in Crimea. They've not made this big offensive that they've been talking about on the southern border of the Black Sea. So we'll see if that plays out. But it looks like Ukraine is essentially crumbling down, and I think they may need to look for some sort of peace talks in the next month or 2. Otherwise, count on Russia cutting off the energy to Europe and causing a massive, massive depression in European countries. Now, we're long NRGU, and we got to realize this is what's been holding back oil, this massive dump of our oil reserve. This is going to stop in 90 days, exactly when the midterms end, which is funny, but what could happen to oil once that ends if the war marches on? Here's a chart of NRGU. We did make massive profit on this last year. We bought the dip, and we're getting ready to sell that as soon as we think the war is going to end. If it's not going to end, we will keep on holding on to it. Now, notably, Occidental is now being controlled primarily by Warren Buffett. That's his hedge for Apple. So that's the same thinking we have with the leveraged NRGU product, but we're more diversified. Also, the way this is working out with the Biden administration is they're making it impossible for the little guys to increase profits by expanding their oil production. So these big companies that are already well established essentially get a monopoly on very expensive oil. And with the so-called Inflation Reduction Act, which they quickly relabeled the Climate Change Act. The plan is to make oil expensive to force people into renewable energies. So that means these 10 companies are going to make massive profits as long as this is allowed to occur. If the Senate remains blue and only the House flips red, I see us holding this position into next year. Now, if the Republicans take over both sides, most likely the price of oil is going to dump. We're going to want to get out of that play. So those are some of the caveats to our NRGU play. Here's a look at oil trading at 91.50, falling, but still at highly profitable levels. You can see it's driven a company like Exxon to record valuations last seen in the Obama era, of course. So we'll keep a close look on these leading indicators for our inflation hedge. This is just a trend chart showing the commodities probably oversold in the short term to buy the dip, which we did. And despite we're seeing a little bit of a weakening in the labor market, it's still robust. There's still massive amount of job openings relative to those looking for work. So we're not seeing a dying economy anytime soon. In fact, there's 5.3 million more job openings today than there are unemployed. Now, this is a little bit old data. It has reduced, but still a severe labor shortage. And as far as all this debt, people are paying their interest payments. We're not seeing a bunch of delinquencies. Now, probably most concerning thing for us with the Fed is the labor force is shrinking. They want this to expand so that the labor shortage comes to an end. So we'll keep a close eye on all of this. Now, this is where the video ends if you're not a paid member. Call Dean to upgrade at 505-322-7515. Okay, I'm going to jump into the track records and the risk calculator now, and then we'll do Q&A. Okay, so our safe growth is up 1.84%, down 15% year to date. It's super leveraged, so if the market keeps going up, as I anticipate into midterms, we're going to outperform the S&P 500 easily. High risk portfolio is kicking some ass, up 5.9% in August, up 47% year to date. If you're doing the 70-30 combo, you're up 3% in June with a total return of 32% year to date. Spectacular, especially if you're following that risk management strategy. Okay, so I'll start off with the safe growth strategy. We're waiting to dump NRGU, and we're going to rotate it into UVXY, Treasuries, and Bitcoin. That's really the play we have set up. So we're just being patient to make that call. If we think there's going to be a big crash because Europe's falling off a cliff, we'll exit the stocks, we'll load up on Treasuries, the UVXY, and we'll add in EUO. For the high risk portfolio, we're now only waiting to dump NRGU and EUO, and we're going to rotate it into topping off UVXY, Treasuries, ETHE, and FNGU. And again, the key will be timing when to sell our energy hedge. Now, long term, I'm very bullish on energy, but we need to realize there's a few catalysts that are artificially driving the price of oil higher, which is Biden not allowing the expansion of refinery or production, and then the war, which is, of course, also being led by America. So if either of those two catalysts were to reverse, we'd want to watch out, dump NRGU, and buy back at much, much lower prices. This could dump to as low as 100 to 200 bucks, currently at 413. Okay, very good. So I'll go ahead and do Q&A and then let you guys go for the week. Okay, Bill says, if you are doing Rebel dividends, what should you do with ETHE? Yeah, the same amount of money that that your calculator shows you have in ETHE, you should have at Rebel dividends. And it would be the way to follow the program. Okay, Michael says volleyball can be answered. Yeah, I got ran over by some big guys. I play the small setter in the middle. I'm only 5'9". Oscar says, hi, Jason. Do you anticipate us changing the safe growth in the next couple of weeks? Won't be available through the second week of September and do not want to be unable to make changes. Well, if you knew what's going to happen with the war, so if the war is going to end, we're going to dump NRGU. So that's really it. If the Republicans take over the Senate and House, I might get worried as well. because they would likely expand oil and get that price to dump. So November potentially, if it's right now, the polls are predicting a blue Senate. So we'll have to keep a close eye on that. Oscar says, are you planning to stay in NRGU for the short term given gas prices are easing off? So we got to remember SPR is artificially keeping it lower. Biden is helping keep it higher with the climate change bill. It literally makes oil have to stay high for a long time. And then the war, if it's going to escalate into winter. So yeah, right now we're not selling NRGU. John says, is EUO a temporary play? Yeah, it's a relatively short-term play, but if the inflation runs hotter than we anticipated, it's going to be a longer-term play. And if the Fed's going to be hawkish because of the inflation, it's going to be a longer-term play. EUO is up 30% year to date. So until we think energy prices are going to drop. Ron says, what's your future forecast triple Q? I think it's going to have a bull market for 2 to 4 years based on the bond market cycle. That in general, we're going to have inflation falling over the next several years. If we do get a split House and Senate, it's going to really slow down spending and keep inflation falling. So that'll be very good for growth to have a split Senate. So yeah, I think we got a nice 2 to 4 year run up on crypto and the NASDAQ, and that there's a short-term risk of the inflation surprising to the upside. So what would really hurt the NASDAQ and crypto would be the core CPI, which fell from 6 to 5.9, suddenly jumping next month. Imagine that. And the Fed won't be able to have all this pivot talk. But the only thing that's keeping that higher right now is the rent, which we know is going to fall because housing prices are falling. The labor wages, that could be sticky for a little bit. Other than that, everything else is falling. Okay, Don says, I was at 75.20. So my track record, basically, I rebalance the portfolio with the 70-30. I'm rebalancing at the start of the month. So at the start of the month, I'm saying, all right, I have XYZ total dollars value in my account, and then I split it 70% to safe growth, 30% to high risk. And so at the start of each month, I'm rebalancing it, and that's what our track record is. So yeah, the start of each month, I would rebalance. Does that make sense, Don? Let me know. If not, I can pull up the calculator and kind of demo that if you want. Carl Ritchie says, what will TMF do if the Fed does another 50 basis point hike? We'll probably trade flat or down if they are dovish. We're probably going to see NRGU rip higher. Joseph says, what would happen to TMF when stocks go up? TMF will go down if NRGU goes up. TMF will go up with Bitcoin and the triple Q is the typical trend. It's not 100%, but in general. Bedro says, did you want us to reinvest BOIL? Yeah, so you sold all your BOIL. You should have 0 BOIL, and then you need to log into the membership area, punch in your total value of your account that you want to invest, and it'll print out what to do. Because we bought a little bit of everything. Usually I tell you exactly what to buy, but it was like 6 different trades. I don't want to confuse people. We spent a lot of money making this beautiful calculator, so we're going to make you use it. Don says rebalance the total of both. Yeah, so just look at your total account at the start of each month, and then go to your calculator and put in 70% of that value into safe growth, 30% into high risk, and then you got your shopping list. Go make sure you own the right of each asset. Yep, yeah, that's exactly right, Don. Jeff says, it's been a while since I reached out. Thank you for everything, Jason. Thank you, Jeff. Okay, Don does understand, so very good. So yeah, let me make that clear. So what I do in this track record is basically, it is at the end of each month, it's taking, let's just say we had $100,000 on the first month. And we say, okay, so we're gonna need 70,000 in safe growth, and we want 30,000 in high risk. let's say at the end of the next month, regardless of what return we made in each portfolio, let's say we're up to 110,000. So now we're going to have to, now I got to do my math on 77,000 in safe growth and then 33,000 in high risk. Okay, now let's say we lose some money the next month. We're back to, let's say we're at 100,000 again. So then we say, okay, well, 70% of 100,000 is back to this. And so I'm doing that once a month, rebalancing once a month. And that's what the 70-30 return is based on. Joseph says, winter's coming to Europe. Would it make oil go up further? And how much do you think it might go up? It could go up way higher. The risk reward ratio is not good. Europe's now trying to, I think it was Spain just made it illegal to set your heater or your cooling below 80. Germany's shutting off heat. Europe's trying to reduce energy use by 20%. It's a hard call. It's a hard call. If the war doesn't end, I would expect oil to go much higher. But small businesses are getting, I think the political pressure to end the war is mounting so aggressively that they're going to have to start reversing sanctions to get energy costs down, regardless of whether or not the war ends, because they're going to piss off too many people. We literally have revolts and revolutions starting to occur all over the world. A lot of people who are prominently pushing for the war are now out of office, like Boris Johnson. Macron's losing power. The Italian government is having their bond market blow up. Small businesses are shutting down because their energy costs are up 500%. And we're heading into elections. So the risk reward on oil with NRGU looks good. Oil just hit, almost a new high. So I'm just not going to flirt with fire. We made a lot of money on it, and we'll just be patient. Rock says, if Talio sold Alibaba, why the bleep are we still in emerging markets? Well, I believe that the second the Fed pivots, China is going to go balls to the wall with stimulus, and you're finally going to love me to death for being long EDC after a year and a half of complete, utter failure with EDC. And despite their weak domestic economy, they still are the manufacturing sector of the entire world. And again, EDC is only 35% China. Great questions, guys. Keep them coming in. Joseph said, did China start the QE a few months back already? They're slowly starting to increase the credit. Yep. But they're not gonna go balls to the wall with credit expansion if the U.S. is tightening, because it's gonna make the dollar skyrocket up and it's make their currency just completely implode. So the China can get away with more QE as soon as the Fed starts to pivot here and as soon as energy costs go down. Do I think Alibaba will be delisted in the US? Absolutely not. It would be suicide. Oscar says, given the Fed needs to pivot to see EDC, why don't we wait till the pivot? Well, I think it's already happening. So they already started to pivot in the last meeting. So next week we get Powell's speech from Jackson Hole, and I believe he will hint that we need to slow down. If he does the opposite, then perhaps you guys are right. We'll finally capitulate and sell at the very bottom. Not a fan of selling at the very bottom. I still think Alibaba is a great company. China's zero COVID policy is what's been very problematic. but it's down just so much. So let me look at how much Alibaba's down. And then Tencent's finally having a hard time generating profits. So Alibaba has fallen from like 400 to 89. So it's down just this massive. I can't get on my little computer. But yeah, it's down something like 80%. So I like buying great companies that are down 80 to 90% from recent highs. Yeah, so even if China is not, or if Alibaba is not on the NASDAQ, doesn't mean it's not available via ADR. So it could be on the Hong Kong exchange. So many of the companies we have exposure to are not in US stock markets. They're in ADRs via ETFs that you can never buy individually. So we're gonna be okay no matter what with Alibaba. But yeah, it went from like 400 to 89. And our exposure to Alibaba is relatively small in all portfolios, under a couple percent. Okay, very good. So we did decide to keep the webinars on Wednesdays. It takes quite a bit of time to update all the screenshots, and then we're really doing a lot of work for Rebel Dividend clients on Monday, Tuesday. So just made the workflow super smooth, and a lot less Sunday work for myself. And plus the charts are more updated. We get 2 days of content to add into the slideshow. So expect Wednesdays moving forward. Don says, thank you, Jason and team, for all your hard work and building our portfolios. You're very welcome, Don. Okay, beautiful, guys. So we will be back next week. Yao says, when do you see TMF will go back up in price? As soon as the inflation's really falling, which I believe it is. Carl Ritchie says, how can I get the details for Rebel Dividend? Call Dean, Carl. We're not allowed to have a marketing for this. It's only available to 35 total non-accredited investors, and they have to have a pre-established relationship with us. So there's limited spacing with the way the securities laws work with this. And I think we're almost full. So call Dean 505-322-7515. If you're accredited, we can have an unlimited amount. You still have to be a pre-established relationship, which we make the case with to the SEC by showing that you're a newsletter subscriber. Joseph made 110% on Boyle. Very good. Yeah, so it must have gone down from my entry because I only had a 63% return. You devil you. I know John Johnson, who used to work on our sales team, made up over 100% on it too. So, and remember, the portfolio is diversified so that each position protects another position. So we're not trying to make all positions go up every single day. Okay, very good, guys. Thank you so much. We'll see you back next Wednesday. If you're in Rebel Dividends, we're going to get our dividend out Monday and webinar on Tuesday. Thank you so much.